All things disclosure. Joined today by Nick Dumont, who's VP, Director, Transaction Advisor Leader for Lockton. Nick was a practicing attorney for many, many years. He's way out in front about AI, and now AI is here. And we're going to talk to Nick about a variety of things today on realtransparentdisclosure.com. So, Nick, thanks for joining us. We first touched base back in 2017 when you wrote a piece about machine learning and AI and its impact on disclosure. Seriously, in all my years of editing and being in publishing, when I saw that piece, I was like, this person is going somewhere. And I reached out to you and published it in the Corporate Governance Advisor. It really was way ahead of its time. And you're doing interesting things. You've been practicing for nearly 20 years in a traditional role, but now you're doing something a little bit unique. Do you want to describe what you're doing for Lockton?
Yeah, sure. So I'm a transaction advisor at Lockton in our technology risk practice group based here in San Francisco. And what I do is help companies think about risk a little bit differently. I leverage my legal experience, my transaction experience, my corporate governance experience, my disclosure experience to help companies understand risk as they go public, either through IPO or through a de-SPAC, as they do M&A, as they do restructuring activities, all with a lens to make sure that they understand their risk a little bit better and that we're providing the best service and products to address that risk going forward.
So, Nick, how does SEC disclosure impact the reputation of a company? In a secondary question is what role do alternative data sources play?
Sure. So I think we need to look at this from a historical perspective, and there's been a bit of a boomerang effect in my analysis of it. When the federal securities laws were first passed in the 30s and 40s, there was really no information about a lot of companies. It was very difficult to obtain information about companies. And the laws that Congress passed and that were later enforced were really designed to make sure that investors had access to information. So SEC disclosure, mandated disclosure, will really form the backbone of a company's kind of informational reputation. Um, Technology, I think, later changed that. Um, Simply put, companies wanted to get in front of their investors a bit more, and using the internet, they were able to do so. A lot more press releases, a lot more presentations, a lot more webinars, a lot more PDFs, a lot more slides. And so SEC disclosure, the way that we think about it, annual reports on Form 10K, quarterly reports on Form 10Q, et cetera, fell into the background and it became viewed maybe unfairly as just a compliance thing. I certainly heard this in private practice. Oh, compliance will take care of that. It's just, a report. It's going to be largely the same as what we did the year before. I think AI has changed that fundamentally. Using AI analysis, investors, regulators can get a lot of information about companies in somewhat dense SEC reports. They can capture the essence of those reports very quickly. They can transform those analyses into trading behavior very, very fast. And so all of a sudden, I think SEC reporting has really come back as a bedrock of any company's really informational reputation. That's a fundamental shift in the way that this was perceived.
Yeah, I've just recently been blogging on thegovernancebee.com about how investors are using AI to analyze disclosure. But it's interesting on the drafting side, I think it's not been as fast as an uptick for those of us in law firms or in-house to use AI to help draft disclosure. So it'll be interesting to see when that evens up more. I think it's catching up fast now. AI is definitely in the mainstream. Just over in the last few months, it's amazing. But I think they're right this moment, there might be a little bit of an imbalance.
Yeah, so a couple things on that. Um, in terms of AI analysis, this has been with us for a while. I first became interested in this topic in 2010. Um, Natural language processing has been used to analyze SEC disclosures, to analyze press releases for a long time. Um, at that time, The depth of the analysis and its sophistication, I think, was rather limited, right? There's standard dictionaries of good words and bad words. You could run a 10K through software and say, well, do we have more bad words than good words? How is this company trending, right? So red flags like litigation or restatement would be triggers, right? But without much nuance or without much context. I think that's changed recently. The compute has become cheaper. The LLMs have become much more sophisticated. And so the ability to extract kind of contextual analysis has increased exponentially. That I think is a really key shift in the last maybe 2 or 3 years that we didn't see maybe 15 years ago. On the drafting piece, a couple of thoughts. Um, First, I think, and this is something I talked about in this article, ever many years ago now. Um, it seems, if we're to believe what's been reported in the press, that the tone of SEC disclosure has changed pretty radically. There was an article in the Wall Street Journal a few weeks ago that was written by a professor in Israel, which suggested that overall the trend in SEC disclosure is to talk in positive tones. Now, why would that be? Even if the company is not performing very well, right? That doesn't make any sense. I think if you looked at this maybe 15 years ago, the basic assumption, the heuristic would be, listen, if the SEC disclosure is short, that means that it's good, right? There's nothing much to say. The company's doing very well. If there's obfuscatory language, if there's a lot of dense verbiage, that means the company's trying to hide something. That's the way we did it. Companies have grown up. And it seems, if we're to believe this report, and it actually doesn't surprise me, that we're reacting to the advent of AI analysis in the disclosure and changing the words that we're using in order to describe corporate performance. I think that brings about a fundamental tension that advisors have to wrestle with. I think it's perfectly fine to tailor a message to one's audience, right? We know that AI is looking at this stuff. It's fine to try to tailor it to get a better result. But the problem is if those changes result in disclosure that's inaccurate or misleading, there could be reputational consequences, if not legal ones. And so advisors, I think, have a really critical role in making sure that any changes that we make in response to AI analysis are justified and can be justified in retrospect. It also brings about, I think, kind of a cat and mouse game, right? We know that AI is analyzing disclosure. We change our disclosure in response to AI. The AI then reacts to that improved disclosure and is able to kind of figure out the game. Eventually, there's going to have to be some sort of compromise. I don't think we're there yet, but that's clearly where the market is evolving.
So let's put on your risk management hat, since that's what you're doing a lot right now. What impact could these trends have on litigation risk and the cost of D&O insurance? And, sort of putting on your hat, advising boards and senior
Sure,
management
sure.
about these issues.
So I think in terms of overall cost for D&O, we haven't been able to see anything just yet, but there are some issues out there that I think boards need to be aware of. The first is one that's been in the press for the last 24 months, and that's just AI washing. This was something that the previous SEC administration uh, paid a lot of attention to, worry about companies kind of hyping their AI abilities well ahead of where their capabilities were. That's a problem that I think boards need to pay attention to, making sure that their disclosures can be justified and are sensible and reasonable in that regard. The other piece of it is what we just talked about, right? I mean, if in fact we are now changing our disclosure in response to AI analysis, there's got to be a very deep dive, at least in my opinion, on the advisory point to make sure that all of these changes actually make a lot of sense. And I think that's a significant area of risk that we need to pay attention to. The third one, I think, is just an operational one. This is outside of the realm of disclosure. As companies deploy AI, I think their risk profile changes, right? We're integrating a lot of new technology very, very quickly. And especially if that technology is consumer facing, I think companies face a lot of risk that they need to think about. We at Lockton have developed products to deal with some of that, right? To make sure that we have, quote, AI insurance. But it is something that boards need to pay attention to and that management needs to be aware of. It is great to deploy new technology. Just be aware of where it could be going. And finally, I guess the last thing I would say about AI and risk is just be aware that everyone else is deploying AI too. Insurance carriers that are evaluating companies for risk for D&O are using AI. Banks that might be underwriting your deals might be using AI as well. Be aware that kind of everything you say now is being tracked and analyzed and could be cross-referenced very easily in the future. That's something that just boards need to pay attention to.
I mean, Big Brother's been watching us for a while, but that's now Big Brother and all their friends. So the other hot topic these days is reincorporation, companies potentially leaving Delaware for other states. Do you have a bead on how that might, has that changed D&O insurer rates yet, or I guess it's possible in the future?
Yeah. So it's too early to tell. Simply put, there just aren't enough data points just yet to assess the effect of that on D&O rates. Obviously, we are fielding a lot of questions from clients that are thinking about either incorporating or reincorporating the states that you just mentioned. Especially here in Silicon Valley, there's a lot of interest in looking at those states. But from a D&O pricing perspective, we just haven't seen a lot of movement just yet. I think if those states manage to attract a lot of attention, that will obviously impact the way the way D&O pricing is conducted. But for now, it's still in early innings.
So you were way ahead of your time, and you sound like you still are. And thanks so much, Nick, for joining us and educating us. This has been great.
It's a real pleasure. Thanks for having me.